Most people do not really test their own view on life and also the stock market. They find a company they like, they collect the points that support it, and they repeat those points until they feel more sure. That happens all the time in the stock market. It feels good because it's known as confirmation bias, and it usually leads to weak thinking. So today, we are doing the opposite. Instead of building the easy bull case, we are going to walk straight into the bear case. Not the weak version, not the lazy version, the strongest version. Because if you want to truly understand a company, you need to be able to look at this through an objective lens. You have to know what could go wrong. You have to know why smart people are betting against it. And in the case of HIMS, that matters even more because this is not some small disagreement at the edges. There is real money betting against this business, and that means the concerns are not just random noise. They have come from people who have looked at the numbers, the filings, the regulation, the margins, the deals, and the structure of the company and decided, you know what? This stock should be worth less than what it is today. And this deserves a real answer. So in this video, we're going to be going through the biggest short seller arguments one by one. We'll look at what the bears are saying and why some of those points matter and where their case is stronger than the bulls admit, and also where the bear story starts to fall apart. The goal here is not to cheer for a side. The goal is to get very, very decisively clear, because if the bear case still stands after real pressure, you need to know that. And if the bull case survives that pressure, you also need to know that too.
Welcome to the game, it's the Instant Stocks by Mikhail.
But before all of that, if you don't know who I am, my name is Mikhail, and one of my highest values in life is freedom. It's why I've partnered with X10 Day Trading for over the last 4.5 years. We have built a complete done-for-you day trading service where you get to leverage our team of professional traders through our software, and you just need to fire it up every single day and watch the profits come in month after month. Why we can speak with so much certainty in the profitability of what we do is we have millions of data points over the last 4.5 years where we project a return of 5 to 15% every single month. So let's look at our month in March so far. We have made 11 trades so far. And so far, we have had a result of a 77% return. That means if you started with us at the start of March, you would have already seen a realized profit of 7.7% in your total portfolio value. Completely hands off, completely done for you. Now, we have clients like this and this and this, with portfolios anywhere from 10 all the way up to $500,000 that our software is trading every single day. Just here yesterday on Tuesday, the 17th of March, we took a call with Amazon with a 7% return. Might not look amazing, but what we do is compound these percentages every single day, every single week. And if you started with as little as $20,000 in your portfolio with our current run rate, you would be over $100,000 at the end of the year. And in 2 years' time, you would be looking at over $550,000. Let's look at a quick comparison that we sent through last month for our members up until February. So this is a timeline from September all the way up to middle of February. If you started with us in September, you would see a 38% increase in your portfolio. If we compare that to the S&P, ARK, Microsoft, Meta, Palantir, Hood, you can see where they're currently sitting if you've just been holding those stocks. Another variation here is September, October. You can see the monthly percentage returns in your portfolio every single month. And also another metric here for all my graph geeks like myself, my numbers guys, this is also how you can see how it's been progressing over the last 6 months. So if you're looking for a way for your money to work as hard as you do, you don't want to stare at a screen all day, or maybe you've already lost money trying to learn how to day trade, this could be exactly for you. You need at least $10,000 to allocate to your portfolio. And if you want to go a layer deeper, there'll be a link below, or you can go to x10daytrade.com where you'll jump on a call with myself personally. I'll walk you through our entire members area, all of our trades over the last 6 months. You can see exactly what we're doing day to day. We also have a 100% money back guarantee. So check out the link below, and I look forward to seeing you on a call soon. Without further ado, let's get stuck into today's video. Let's start with setting. HIMS has a very large short interest, and that matters because it tells you this is not a small disagreement. A lot of people are betting that the company will stumble, slow down, or disappoint expectations, or even lose value. That alone does not make the bear case right, but it does mean the market is deeply divided. And when a stock creates that kind of split, you want to know why. And usually the bear case comes down to a few core ideas. But one of the main things I want to speak to today is the confirmation bias we see all the time in the market. You'll have it in your own life. We'll have it in stocks we like. We're looking for the angle we believe to be true because it just confirms our view on the thing more. So you see this in politics all the time. Someone will come give a huge talk on a certain subject and people will cherry pick certain things that are said because it makes them feel right. It makes them feel smart. It makes them feel like their decision is right, and no one likes to be wrong. And one of the things with this is what creates what I believe to be a really good trader, long-term, short-term, medium-term, whatever that is. If you were to view life through a lens, and when you look at life through this lens, every single thing that has happened to you in life adds a filter to the lens. If you've had past experience with certain companies, if you've seen certain price action before, if you've had a certain story with money when you were growing up and a certain experiences in day trading or whatever that is, this now stacks a filter in your lens on how you view the world. And what happens here, once you stack up all these filters in the lens, you have a subjective view on the world. So you will see things completely different to somebody else. The ability to be a good trader is to be able to look at things objectively. What does that mean? That means removing the confirmation bias, the stories you've already told yourself about what you believe to be true in the world, the market, a certain stock, your parents, your friends, jobs, companies, businesses, whatever that is. When you can look at something objectively, you can take your emotions, your feeling away from it, and you can remove these filters. And this is what I truly feel makes a good trader. It just makes a better overall human as well. If you can see the world for objectively what it is without confirmation bias, you can start to see reality more clearer for what it is. And long-term, this is going to help you in every area of life. But let's get into the specifics about how the bear case here comes down to a few core ideas. There's things that they're looking for. Margins may get worse. Regulation may turn against the company. Competition may get stronger. The acquisitions may become a mess. The stock may still be too expensive. And on top of that, some people worry about the amount of control held by the founder. Those are the main pressure points. So let's take them out one at a time. The first bear argument is margin pressure. So this is probably the strongest one. The basic idea is simple. Bears say HIMS had a period where some of its weight loss business was much more profitable than what comes next. And if the company now shifts towards branded drug distribution, then the profit of each sale may be lower. In plain terms, it may be selling a bigger product category, but the margin and the profitability of this is a lot less, meaning they just keep less of each dollar. Now, this really matters because investors do not just care about revenue. They want to know how much of that revenue turns into gross profit. They want to know how much of that turns into net. They want to know how much of that is EBITDA and how much of that is now there to leverage to grow the company even more. See, a company can grow and still disappoint if the quality of revenue gets worse. This is the heart of the margin argument. Now, the bear view on this would be that HIMS benefited from a very favorable setup in the earlier phase of its weight loss business. That gave the company unusually strong economics, right? If that phase fades and gets replaced by a more basic distribution model, then the company starts to look a lot less like a high margin health platform and more like a lower margin middleman, which is fair. And that is real concern. So this is where the bulls make mistakes sometimes. They act like any margin concern is just FUD, it's fear or just bad faith. And it is not. It is actually a real issue. But the bear version usually stops too early because it treats the company as if one category tells the entire story. And it just doesn't. HIMS is not only weight loss. And this is a big thesis where the bears have been holding onto this weight loss narrative. It's only that. It has hair loss, skincare, mental health, sexual health, women's health, and other treatment plans. Some of these areas still have strong margins and better retention. So when you think about the company, you cannot act as if the full business will suddenly take on the economics of just one lower margin product line. That wouldn't be fair to be able to draw that narrative. There is also a scale argument here that matters because even if a margin on a single prescription is lower, a larger business can still become more profitable over time if the fixed costs grow more slowly than revenue. The app does not need to be rebuilt from scratch for every new subscriber. The brand can spend work across categories. The company can spread its overhead across a much bigger base. Now, that does not completely erase the margin issue, right? It just changes how you frame it. This becomes less of a death blow and more of a transition problem. That is a very, very big difference. A transition problem says the next few quarters of even the next couple of years may feel messy. A death blow says the long-term model is just broken. Those are not the same thing. That is a completely different argument. And I think this is where the stronger answer sits. Margin pressure is real. Yes, people have expectations and they consistently want to see the company reaching them, but it does not automatically destroy the company if the broader platform keeps growing and fixed costs get more efficient over time. The second bear argument is regulation. This one will never really fully go away because healthcare is just always regulated. And that is just the reality of the space. So if a company wants to operate in medicine, prescriptions, telehealth, pharmacy, and treatment and delivery, it has to live inside a web of rules. And those rules can change. This is one reason why short sellers are really drawn to healthcare names. Regulation can create sudden risks, a rule changes, a practice gets limited, a state tightens standards, a drug category gets new oversight, and suddenly the market has to reset its expectations. Look, bears look at HIMS and say this company sits too close to too many moving parts. You've got telehealth rules, prescribing rules, you've got pharmacy rules, you've got strict regulation, you've got drug-specific rules, you've got state rules, you've got international guidelines and rules they need to adhere to during expansion. And because HIMS is trying to push healthcare into a more digital and direct model, the company may be more exposed than a slower, more traditional operator. Now, that is not a silly argument. That is a fair argument, and it's a very rational and logical one. But again, we have to ask the better question. The better questions you ask in stocks, business, and life, the better answers you will get. So the question is really, is the risk getting worse or is the risk getting better? Because risk is not just static, it has direction. And here I think the direction matters a lot. If a major drug company is willing to work with HIMS, that says something. That says a lot. Large drug makers do not casually tie themselves to platforms they think are reckless or unstable. They care deeply about compliance, safety, and massively reputation. So when HIMS is able to form a serious partnership, it suggests the company is not operating outside the line in the way bears simply imply. There is also a broader trend to think about. Telehealth is not moving backwards as a whole. There may be adjustments, there may be tighter rules around some cases, there may be more scrutiny, but the world is not going back to the idea that healthcare must happen only in person for every routine needed. That shift is important. This is where I feel like HIMS is going to be a big disruptor in the space. They already have been. People have now used digital care at scale. They know the convenience. Providers know the demand exists. Healthcare systems know it can reduce friction. So even if the rules evolve, the long-term direction still appears favorable for digital healthcare platforms that can operate responsibly. That means regulation should be viewed as an ongoing operating risk, not necessarily as a full break in the thesis. And there is a big difference between those two things. The third is really the bear argument is competition. This one sounds strong on surface because the digital health space is crowded. Once a category becomes interesting, everyone enters. New startups show up, big companies show up, drug makers show up, tech players show up, and suddenly the market feels very noisy. So the bear view says HIMS has no special protection. The products can be copied. The app can be copied. The ads can be copied. Everything on this top level can be duplicated. Even the consultation process and flow they take people through can be copied. So if larger companies decide to compete really hard, HIMS may get squeezed on price, on marketing costs, and on customer attention. And that's fair, but it does miss something very important. Healthcare is not a normal online shopping category. People do not choose healthcare the same way they choose socks or phone cases. Trust deeply matters with this. Friction matters more, and privacy matters again on top of that. The feeling of being understood matters so much more than what the price label is. And some people, you're going to be people out there that are just hunting for the cheapest possible thing. That's going to exist in every single market. But trust is going to be the thing, is going to be the catalyst that helps a company grow. If you're just purely competing on price all the time, it's going to be a race to the bottom. And that changes the value of the brand. A healthcare brand that people actually know, already trust, and already use for sensitive treatment areas has a real advantage. That advantage is not perfect, but it is more durable than bears often admit. And then there is the subscriber base. See, once somebody is already in the system and has a history on the platform and has a healthcare that is working and has gotten used to the refill experience, switching becomes harder, not impossible, but harder. And with the implementation of things like AI, and a company can have thousands and thousands of data points of someone's experience, they can prescribe and diagnose much better over a longer time frame. Now, that is especially true if the company can cross-sell well. A person may join for one reason and then stay for three. That creates not only width in the market, so width would be expansion, going into different countries, expanding different product lines and things like this. This creates depth. So depth is just simply how much money each client spends when they come through the doors. And also, how much do they deeply have an emotional tie to the company? We're going to that trust factor again. And this is much, much deeper, much more important than a one-time purchase. So yes, the space is competitive and it can and probably will get more competitive, but not all competition is equal. A company can enter a category without truly matching the position of the leader. That happens all the time. So if we talk about the biggest name that always comes up in conversation, Amazon. The bear argument here is obvious. Amazon is huge. It has money, it has logistics, it has customers, trust in delivery, pharmacy capability, and the ability to push a new service in front of a giant user base. So if Amazon wants digital health, why would HIMS win? And it sounds like a serious threat, but history really points to some key things here. See, Amazon has had time and resources in healthcare and still has not become the clear leader in personalized digital health. That tells us something. It tells us this category is not solved just by scale. It is not solved just by fast shipping. It is not solved by having a giant customer base. Healthcare has a different texture. It requires a relationship that is different. It requires a brand that feels built for care, not one that simply adds care as another tab on a massive platform already. That is why I think the competition argument is only partly right. Competition can pressure prices, it can raise acquisition costs, it can narrow some margins, but it does not erase the brand and data advantage HIMS has built over time. The fourth bear argument is just about acquisitions. Sales. This one is very important because even a good business can create its own problems by trying to do too much too fast. And the concern is simple. HIMS has made several moves to expand beyond its original shape. That can open huge growth path, but it also creates integration risk. When you buy businesses in new regions, you are not just buying revenue. You are buying systems, teams, local rules, habits, culture, and you've even got a team on the ground that have already had experience in space and touched the edges of regulations. And then you have to make it work altogether. Now, that is hard. The bear view says that this creates two dangers at once. First, the company may struggle to blend all of these moving parts into a single clean operation. Second, management may get distracted from the core US business at the exact time that core business already needs careful attention. So that is a strong argument because almost every investor has seen some version of this story before. A company is doing well, it starts to expand fast, it buys too much, it promises synergy, and then the next 2 years are just full of delays, weak execution and culture clashes, and now targets are harder to hit than expected. So this can happen. I'd be lying if I said there was some kind of guarantee that they're going to execute perfectly. There never is. If you model HIMS over the next couple of years, you should probably expect some friction. One region may underperform, one integration may move slower than planned, costs may be higher than hoped, and that would be completely normal. But again, the full story is not just about the difficulty. It is about the strategic value of getting there first. Building from scratch is new markets take time, money, and local knowledge. Buying a real platform in a market can sometimes be the faster and smarter path if the price makes sense. So the question is not simply whether integration is hard. Of course it's going to be hard. The better question here again is whether the company is buying meaningful assets that would be harder and more expensive to build alone. If the answer is yes, then short-term friction may be worth it. That is why I see this as a real near-term headwind, but not necessarily a reason to reject the long-term strategy. The fifth bear argument I want to speak to is valuation. Now, this one deserves respect because sometimes a great story is still a bad stock if you pay too much. Bears say that even after the stock has pulled back from past highs, HIMS still requires strong execution to justify the price. If earnings disappoint, if margins weaken, or if the growth cools faster than expected, the stock could re-rate lower. That is true. This is not a sleepy low multiple value stock. This is a company the market still expects things from, and when the market expects things, misses really matter. A stock can fall even while the business grows if investors decide the future is less exciting than they thought. Now, that is what makes the argument tricky because unlike some of the other bear points, this is not really about whether the business is good. It is more so about how much optimism is already in the price. And for a short-term investor, that is a serious issue. If your time frame is short, valuation can dominate everything for you. A good company can still hurt you if the market resets the multiple. Now, for a longer term investor, the question starts to shift and it looks different. Can the company become much larger over time? Can the company grow revenue strongly enough? And can it improve the business mix? Can it create enough operating leverage? Can it use brand, subscriber base, and new markets to build a far bigger platform later than it is today? If yes, then the current price may look reasonable in hindsight. If no, then the stock is too rich. That is why this is really a time horizon question. Value investors may hate it. Growth investors with patience may see it differently. Both can be very rational. Now, there is one more issue that matters, and that is governance. This is not always the first thing people talk about, but it matters a lot more than many retail investors think. Founder-led companies can be great, because a strong founder can move fast, they can think long-term and make big decisions without getting trapped in short-term noise. But there is another side to that. If power is concentrated too heavily, public investors may have less ability to shape major decisions. They are placing trust in one leader and one small circle around that leader. So the bear concern here is not hard to understand. What if management makes a big mistake? What if they overpay? What if they push too hard into a weak strategy? What if they misread risk? Now, in a more balanced governance structure, shareholders and the board may be able to slow that down. In a founder-controlled structure, that check can be weaker. Now, this is real risk because it is also one that has to be weighed against results. If the founder has a strong track record of building the company, entering new categories and moving the business forward, the market may tolerate that structure more easily. So I would not ignore this issue, but I would also not treat it as a clear break in the story unless the execution starts to fail in a sustained way. So if we step back and score the whole bear case honestly, the margin argument is real. The regulatory argument is permanent but improving. Now, we've just seen that with the recent deal with Nova. The competition argument matters, but it is often overstated. The acquisition side of things is probably the most likely source of short-term friction outside of margins. And around the valuation argument, it depends just a lot on your time frame. The way you see the valuation right now is going to depend on what your intention is with your investment into the stock. And the governance argument is real, but it's just not unique to HIMS. Many founder-led growth companies carry that same trade-off. So what does all that mean? It means the bears are not completely crazy, and that is important. They are not making things up from nothing. There are real risks here, and if you own the stock, you should really own it with open eyes, just like every stock. Look at it objectively. You should know that margins may be messy. You should know that healthcare regulation can shift and that also international expansion can create headaches. It's not probably all going to be smooth sailing, and that a premium stock can fall hard on disappointment of not meeting expectations. All of that is true. But here is the part where I think the bear case starts to lose its force. It often assumes every risk will hit in the worst possible way. Margins will weaken more than expected. Competition will get harsher than expected. Acquisitions will go badly. Regulation will tighten. The multiple will compress. Leadership will misstep. And that is a lot to stack together. Could that happen? Yes. Could it all happen together? I don't think so. And is it the most likely full path? Probably not. The market often breaks by overstacking risk on one side or overstacking optimism on the other. Both of those can be bad traits to look at the stock through, but the better approach is to ask whether the company has enough strength to absorb the normal setbacks that come with growth. And HIMS does appear to have real strength. It has a recognized consumer health brand. It has a large and growing subscriber base, and it has multiple categories. It has growing experience in digital care, and it has real cash generation. It also has a stronger public presence than many smaller rivals, and it has management that is willing to build aggressively. The last part creates risk, yes, but it also creates upside because companies that matter rarely stay static. They push, they stretch, they expand on edges, they make bets, and sometimes those bets can go wrong, and sometimes they can build the next phase of the story. So that is really what this stock comes down to. Not whether risk exists. It does, it always will, but whether the market is overestimating how damaging those risks will be relative to the long-term value of the platform. And for me, after you walk through the strongest short arguments carefully, the answer is that the bull case still stands. Not untouched, not completely clean, not easy, not simple, but still standing. This is not a simple story where every problem disappears. It is a company in transition with real pressure, real opportunity, and a path that could look messy before it looks obvious. That makes it uncomfortable, but uncomfortable and broken are not the same thing. A lot of the best growth stories look fragile in the middle. Us here at X10, we were early on Palantir, Tesla, and now we're looking at HIMS. We've called the bottom on this. These are not the comfortable times to get involved in stocks, but it is often the price of trying to build something bigger than the market first expected, and also the price and risk you can take when depending on what the goal is for you being in the markets. The cleanest way to recap and say all this is the bear case on HIMS is not fake. It has real substance. The margin questions matter. Regulation, competition, acquisitions, valuation, leadership structure. It all matters. But none of those points on their own clearly destroy the long-term case. What they do create, though, they create a test. They create a test of execution, which we saw this recently with the big Novo headline. It creates a test of discipline and a test of whether the business and the team can move through a harder phase without losing the bigger opportunity in front of it. That is why this stock creates such a split. One side sees a fragile company with too much hype around it. The other side sees a growing platform with near-term pressure and long-term upside. And the truth may be that both sides are seeing part of the picture. So here is the question. When you look at HIMS from this angle, do you think the market is correctly pricing the risk? Or is it still missing how much strength the business may have under the noise? Now, if you're interested in investing in HIMS, or if you're already entered in a position, I will be bringing you videos every single day, 10 videos a day on this channel. So I'll see you again tomorrow. Make sure like, subscribe, do all the things. Enjoy the rest of your day, and I'll see you tomorrow.